Welcome to the last mini lecture for Chapter 8, and that is Learning Outcome 8-4, Compute and Interpret the Receivables Turnover Ratio. Just like we have metrics or ratios for assessing things like inventory turnover, we also have ratios for assessing our ability to collect on our accounts receivable, in other words, to collect amounts owed to us from our customers. And it tells us here that managers, directors, and investors, and creditors can evaluate the effectiveness of a company's credit granting and collection activities by conducting a receivables turnover analysis. When a company sells goods or services on credit, its receivables balance goes up. And when it collects cash from customers, the receivables balance goes down. This process of selling and collecting is called the receivables turnover, and it's repeated over and over during each accounting period for each customer. The receivables turnover ratio indicates how many times, on average, this process of selling and collecting is repeated during the period. The higher the ratio means the faster collection of receivables, and the shorter the company's operating cycle, which means more cash is available for running the business. Now let's take a look at the ratio itself. The net sales revenue is divided by the average net receivables. We see the word net twice. And remember, net means something has been subtracted. Think back. What is subtracted from sales revenue? It's the discounts and returns and allowances. That gives us net sales. And what's subtracted from accounts receivable to arrive at net accounts receivable? It's the allowance for doubtful accounts. Now what they're asking you here is to average the net receivables. If you're within the company working, then you have access to 12 months worth of data, and you can add the ending balance of accounts receivable, net receivables, up for 12 months and then divide by 12. But if you are not working within the company, and you're perhaps an investor or a creditor, you may have access to only year-end data. So you can take last year's ending net accounts receivable plus this year's ending net accounts receivable, add them together and divide by 2 to get the average. The days to collect tells you how many days on average it takes from sale on account to collection on account. Now, how do we know whether either the ratio or the days to collect are good numbers? Well, look at your credit policy. If you remember, the credit terms tells you or tells your customers the time that the customers have to pay. In other words, what's the allowance of time they have to pay off that amount that they owe you before they encounter a financing charge. So you look at the company's credit collection policy or credit terms. If your terms are net 30, then you expect the customer to pay within 30 days, and your days to collect should be 30 days or less. And how many 30-day periods are there within a year? Well, roughly 12, right? Because there are 12 months in a year. So your ratio should be 12. So whether your receivables turnover ratio and days to collect are good or not will depend on what your company's credit policy and credit terms are. You can compare yourself to other companies, but again, bear in mind, it depends on what your company's policies are. Okay, now let's take a look at speeding up collections. One way to speed up collections is to factor or sell your accounts receivable. Here's the definition. Factoring receivables is selling outstanding accounts receivable to another company, and we call that company a factor. Through a factoring arrangement, your company receives cash for the receivables it sells to the factor, minus a fee, And the factor then takes over collecting the outstanding amounts owed by your customers. This other area we talked about when we had our first lecture on this chapter, and that's credit card sales. If you do not want to host credit yourself and bear the risk of loss, in other words, non-collectability, one way to allow your customers to buy on credit but not experience in that loss is to allow them to use credit cards. In other words, things like PayPal or Visa, MasterCard, American Express, Discover. You will get your money within 1 to 3 days. With MasterCard and Visa, you usually get it within 24 hours. With American Express and Discover, it's usually a little bit longer, but still, you will get your money up front, less a fee. And then it's the credit card company's responsibility to collect from the customers. We're all done, and now you can take a look at the demonstration problem for the accounts receivable turnover analysis.